Most Americans are building their retirement inside a tax deferral contract and calling it a retirement plan. Those are not the same thing, and the difference will matter more in the year that you start withdrawing than it does today. Welcome. My name is J.M. Eberhardt. I am the founder and managing advisor at King Legacy Group, and I want to thank you for being here. Before we get into the content today, I want to be upfront about something. What I'm going to walk you through is not theory. It is built on actual tax code, actual client work, and actual outcomes that I see in this practice every week. I've spent years working with business owners, executives, and professionals who are doing everything right by conventional standards. They are saving consistently, they are investing, they have a plan, and yet the moment that they get close to retirement, they start discovering that their plan has a tax problem that no one told them about until it was too late. Today, we are going to address that problem directly. We're going to cover exactly how the federal tax code treats different retirement account structures, why the account that worked for you during your earning years may work against you the moment you stop working, and what a properly structured alternative produces in real after-tax dollars after a 20-year retirement. Okay, I'm going to show you a side-by-side comparison later in the video that I want you to save, not because the numbers are dramatic, though they are, but because the structure is something most people have never seen laid out clearly. So let's get into it. All right, let's talk about what a 401k is. Here's something worth saying out loud: not a retirement plan. It's a tax deferral mechanism. It was never intended for tax savings. Every dollar you put in reduces your taxable income today. You get a break now, but every dollar you take out in retirement is taxed as ordinary income. The government does not forgive that tax. It defers. You are making a deal with the IRS. Pay me later. That deal makes sense if you believe your tax rate in retirement will be lower than the rate you have today. And for decades, that was a reasonable assumption. But here is the reality. Tax rates in the United States are historically low right now. The national deficit is at a level that most economists agree is unsustainable. Current tax provisions are scheduled to change in 2027. When tax rates increase, and most projections suggest that they will, that deferred tax obligation becomes more expensive, not less. So you are not avoiding taxes, you are scheduling them. The question is, at what rate? I suggest the one that you can control, and that's now. Now it's time to discuss required minimum distribution problem, RMDs. Now let's talk about what happens when you hit age 73. At 73, the IRS requires you to begin taking mandatory withdrawals from your traditional retirement accounts every single year. These are called required minimum distributions, or RMDs. The amount is calculated based on your account balance and your IRS life expectancy table. You do not choose whether you take them because it's a rule. Here's what it looks like in practice. If you have built a $2 million 401k by the time that you retire, your required minimum distribution in year one is roughly $80,000. That $80,000 is added to your taxable income for that year, whether you need it or not. They're forcing you to take the money because that's income for the federal government. And that is only the beginning of the problem, because those RMDs can push you into a higher tax bracket. That can increase the percentage of your Social Security income that is subject to federal tax, and they can trigger something called IRMAA, the income-related monthly adjustment amount, which brings me to the part of this that most people have never heard of. Have you ever heard IRMAA explained? IRMAA, the income-related monthly adjustment amount, is an additional Medicare premium surcharge applied to higher income retirees. It is triggered by your gross income, which includes your required minimum distributions, the RMDs. Here's the chain of events. You reach 73. Your 401k forces out an $80,000 RMD. That $80,000 is then added to your modified adjusted gross income. Medicare uses that number to calculate your surcharge for the following year. You now owe significantly more for Medicare Part B and Part D, and you owe it in the same year your required minimum distributions are being taxed as ordinary income. You are getting taxed from multiple directions simultaneously. ordinary income tax on the withdrawal, increased Social Security exposure, higher Medicare premiums, all of it flowing from the same account you spent 30 years being told was your retirement account. That was your retirement plan. This is the structural problem. And the 401k has one more gap worth naming directly. So now let's talk about what the 401k does not have. The traditional 401k does not have a guaranteed tax-free death benefit. Whatever is left in the account when you pass becomes taxable asset. It becomes a taxable asset for your heirs. They inherit the tax problem along with that money. It does not have living benefits. If you experience critical illness or chronic illness or need long-term care, your 401k does not respond to any of that. You have savings and you spend them down. It does not offer market protection without giving up growth. You can move your allocation to stable value, but you give up your upside to do it. If you need to access your money before age 59 and a half, you pay ordinary income tax plus a 10% early withdrawal penalty. And the account is fully exposed to whatever tax rate Congress sets in the future. There's no protection against tax rate increases on the balances that you already built. How fair is that? Now here is what the alternative produces. Section 770 is the alternative. Internal Revenue Code Section 770 establishes the requirements a financial contract must meet to qualify for specific tax advantages under federal law. A properly structured 7702 account deferred. It distributes tax free. It carries no required minimum distribution requirement. There is no age at which the IRS forces you to take your money out, and you can access the account on your schedule, not theirs. It passes a tax-free death benefit to named beneficiaries upon the account holder's death. Your heirs do not inherit a tax obligation. They inherit a tax-free asset. And it may include living benefits provisions for qualifying health events, including critical illness, chronic illness, and disability. The account responds to your life, not your death. Growth is indexed, meaning your credited returns are tied to a market index. In strong market years, you participate in the upside. In down market years, the account has a floor, and zero is the floor. You do not credit losses. That last point is going to matter significantly when I show you this comparison. Now we're running the comparison. I want you to look at this carefully. There's two retirees. Both start with $500,000. Both need $40,000 a year in after-tax income. Same starting point, same income target, but different account structures. Now, retiree A is in a traditional tax-deferred account like a 401k. To net $40,000 after tax at 22% effective federal rate, retiree A must withdraw $51,282 gross each year. That is $11,282,000 per year paid in taxes before a single dollar reaches their pocket. In year 7, the market drops 13%. Historically, the market drops significantly, approximately every 7 years. Retiree A absorbs that loss, then continues pulling $51,282 from a reduced balance. In year 13, the market drops another 20%. At that point, the account is effectively depleted. Retiree A runs out of money and receives zero income for the final 7 years of a 20-year retirement. Total net income over 20 years for retiree A is approximately $512,000. Now, retiree B has a properly structured 7702 account. Every withdrawal is tax-free. In year 7, when the market drops 13%, the floor holds. Zero is credited, not a loss. Retiree B continues withdrawing $40,000 per year, and in year 13, when the market drops 20%, the floor holds again. Retiree B completes all 20 years. At the end of year 20, there's still $50,310 remaining in the account. Total net income over 20 years for retiree B, $800,000. The difference is $287,809. Same starting point, same starting balance, same income need. The only variable was the structure of the account. Now, you may ask what to do next. If what you just saw raises questions about your own plan, that is exactly the point. This is not about convincing you that one account is better than the other. They both play their own parts. It is about giving you the information to make a fully informed decision. Most people have never seen this type of comparison. Most people don't know about the required minimum distribution problem until the withdrawal begins at age 73. Most people have never heard of IRMAA. Now you have. If you want to sit down and look at what your specific numbers produce under each structure, schedule a complimentary strategy review at the link below. It's complimentary. There's no pressure, just a clear picture of where you stand and where you're headed. My name is J.M. Eberhardt, the managing advisor for King Legacy Group, where your living legacy is designed. Have a great day.